Hey there, everyone, and welcome to the latest episode of our Market Misbehavior podcast. I'm Dave Keller, founder of Market Misbehavior, president and chief strategist at Sierra Alpha Research. Pleasure to bring some great conversations with you as part of this podcast series. We love talking with top market practitioners, technical analysts, quantitative strategists, money managers, and anyone in between. Sort of get inside their head a bit, learn the lessons that they've learned about market dynamics and trend and momentum analysis, and really focusing on the routines, the approaches that they use, what lessons they've learned as we're all trying to navigate these markets together, and what they're looking out for, right? What their market outlook looks like in the days and the weeks and the months to come. Today I'm speaking with Ari Wald of Oppenheimer. Ari has been the technical analyst there for years. I've known Ari really since he got started in the industry, and it's been a pleasure to see him grow into one of the top technical analysts on Wall Street. He and I had a great conversation, to be honest with you, about bull cycles and bear cycles. And what I love about Ari's approach is really steeped in market history. And I love how technical analysis and analysis of the markets can be a history lesson, right? You're really a historian trying to relate what you're seeing now to what you've learned in previous market cycles. And I think Ari does that better than anyone. So we talk about this bull cycle, this bull market, the 2-year anniversary of the October 22 low, and what that might mean for the third year, which we're getting close to sort of the median bull market cycle coming off of that major low just over 2 years ago. We talked about trend following and the benefits of not fighting the tape. We talked about the S&P, the NASDAQ, equal weighted measures, mid caps and small caps, and what sort of opportunities he sees given the fact that those trends remain quite robust. He had some really good thoughts about interest rates and what rising rates could mean for your portfolio. What the change in the interest rate environment really means for equities and other risk assets. Talked about the difference between high momentum and low momentum names. He had some great data showing how high momentum or trend following really tends to work and has really emerged yet again in 2024 at being a fairly successful strategy. We finished with 3 areas of the market where he's seeing particular opportunity, really looking at long-term charts, and note the number of weekly and more long-term charts that we included as we were having a discussion about market dynamics. So please enjoy my recent conversation with Ari Wald of Oppenheimer. All right, it's a pleasure to sit down with Ari Wald of Oppenheimer. Ari, good to see you again. You're smiling still, I think, here as the bull market has continued strong. And I appreciate you so much sharing some thoughts with us. Things good your way?
Things are great here. Dave, congrats on the new show. Really excited to be on with you. And yes, smiling. The bull market, keeps on though. I'm getting less calls because of it. I always say, technical analysis and interest in it more highly correlated with the volatility VIX there. But
right, the phone always rings
like
more in a bear market than a bull market, right?
It does, yeah. But don't snooze. As soon as you get to these periods, there something's always creeping.
Well, and honestly, I mean, Ari, you've been so kind and generous to come on shows that I've hosted over the years, and I really appreciate it. I think my viewers have always benefited a lot from, hearing from someone like you, but especially now where 2024 has been this kind of relentless incline. We keep making new highs. It is so easy to become complacent when it feels super easy. And I feel like looking back at major tops, there's a rotation that happens at some point, and we don't know when it's going to be necessarily. But before we get to some of the charts that you're sharing, how do you sort of avoid complacency and avoid just sort of getting in a rut of a bull market that's just never going to end? How do you sort of remain attuned to the message of the markets in this kind of environment?
I think what's so important is sticking with process.
Yeah.
That you have your market call, but then you have your methodology. For us, that we say that we are momentum investors that overlay technical analysis on top of our process. This was actually the title of our recent note: momentum over market timing. Take what the market gives you. We should be thinking about owning high momentum. If you get a market setback, that's your opportunity to buy more. And if we do consider the market a little bit overbought and losing some trading action, becoming a little sluggish, maybe it's an opportunity to sell some of the weaker holdings. So it's always just kind of recognizing what's working, where is there vulnerability. If the market tide recedes, we're of the view that the weak get weaker, and it's just being conscious of owning strength and selling weakness.
Any surprises, I mean, as you think of 2024 to date? I mean, obviously it's been a pretty resilient uptrend. Any surprises as you look back at what we've experienced this year? Any areas of the market that were surprisingly strong or weak that you feel like is unusual? Or has this been sort of like a normal kind of rinse and repeat kind of bull market from your perspective?
I guess looking back, we had been playing by these assumptions in the roadmap that the second year of the bull market should continue. I suppose, looking a little bit of a fake out, or at least, a bit of a breakdown that didn't last for long, was that August sell-off, where it wasn't just the sell-off, which maintained a lot of the support levels, but underneath the surface, you had that a very significant move to defensive, low volatility. So as we talk about, what you'd expect to see at a market top, it would actually be that type of shift towards, risk averse and risk off sectors. Instead, that proved to be very short lived. And so we never really got that, what I thought would be a little bit more of a prolonged seasonal setback. And here we are back to new all-time highs.
Yeah, it's interesting. I feel like with a lot of those pullbacks, like July, August in particular, right? You've had that initial rotation where it feels like it could be the beginning of something, but then it never really continues. Good reminder probably to both of us to, again, go back to process and continue to focus on what the evidence is telling us. Ari, you brought some charts with you. I'd love to go through some of these because I think there's some really interesting insights that you're laying out here. You mentioned we're in sort of the second year of the bull market. It's so funny. I know that, but I hadn't really thought about it until I was looking at some of these charts. So I'm excited for you to talk through them. What does it mean that we're 2 years in, and what does year three mean? Talk to us about the experience of the bull market off of that October 22 low so far.
Yeah, and this is what we like to bring to the table. I'm a big, history buff and kind of understanding and looking back at prior bull market cycles. They don't repeat, they often rhyme. But we do think in terms of what has been this 4-year equity cycle. You typically get about a 2.5, 3-year bull and a market reset in the intervening period. So we just thought it was a topical time, having reached the 2-year anniversary mark of that October 22 low, to kind of see how we ranked versus prior cycles at this point, thinking in terms of the gains that we've saw through the first 24 months. And what does that mean looking ahead? And what we found is that, the returns were generally on par with historic returns in the first 2 years. There really wasn't much of a relationship between performance in the first 2 years and whether the cycle continued or not. And the S&P, I think, was up about over 60% over that period. And it wasn't surprising. We kind of almost had to work backwards. Really the only dependency of whether the health of the cycle and whether it, that performance was whether it topped or not. That, looking at average returns, when you did continue beyond year three, it wasn't surprising. You averaged about a 13% gain. And when you topped in year three, the performance was much more mixed. So again, it's about setting that roadmap. But, again, you want to look for your signals, because that's going to be what's more important. You have what you could expect to happen, but then you really have to prioritize what is happening and look at those clues to help shape the roadmap.
I love that. Right. It's sort of, analysis of market history. I think you better than anyone sort of bring some really interesting, thoughtful historical analysis to the table. Just looking at, where we're at now relative to previous cycles. But at the end of the day, right, it's not necessarily predictive. At the end of the day, it's all about what's happening today. And that could be a very unique experience, but kind of gives us a sense of what we're doing now and how that relates to previous cycles. Talk to us about the median bull cycle, how long this one has lasted, and what that means about expectations we should have in mind, I guess, going into 2025.
Yeah, and this is probably the chart that really illustrates kind of how we've been thinking about things throughout the since the start of the bull cycle. That we think in terms of the median bull market cycle. The duration's about 32 months, about 2.5 years. The median gains 70%. We look at the median to kind of de-emphasize the outliers that gets picked up in the average. And so through much of this, like coming into the year, we were saying, listen, this is below average. This is a below average bull. Expect more upside. Expect it to continue. We kind of talked about how fair value would be S&P 6,000 through the first half of 2025. Now we're getting closer to those thresholds. So I wouldn't say we're on borrowed time, but we're at least getting into that window where you have to be on the lookout, especially as we push into 2025. Specifically, I would argue probably the second half of the year when post-election years typically weaken more significantly. So we're now at a point where if it were to top right here, right now, yeah, this would be pretty consistent with what we would consider a full cycle. So again, keying on what's actually happening, I don't think we're at that point. We do expect it to extend into 2025, but now more so, let's say, than a year ago, we're going to be, increasingly, looking for any potential warnings that would suggest otherwise.
It's so interesting. In your next couple slides, I'm excited to kind of go through because arguably we're not seeing a ton of warning signs necessarily, but let's talk a little bit about the evidence. Particularly, I was surprised, this next slide talking about the strength in utilities. Utilities at sometimes has been, an interesting area of the market, but we've sort of come back to that continued strength in some of the mega cap growth names that have done so well. What does this mean about utilities going forward? Interesting opportunity, I would assume, right?
Yeah, so utilities have been on, we've been talking about it, since that August sell-off, we upgraded them to market weight, just kind of respecting the turn. And I love this study. We just put it together this month. We went back and we wanted to not just look at typical market performance in the third year, but sector performance. And we went back to the 1930s and we keyed specifically on the cycles that lasted to at least their 2-year mark. So we stripped out all of the shorter term cycles. And here we're just kind of noting, did the sector outperform or not in that third year? Yes or no? And then we differentiated by whether the cycle continued beyond year 3 or if it topped in year 3. So, first on the surface, we found utilities and healthcare outperformed more than any other in the third year of the bull market. But then as we dug a little bit deeper, we found that, well, actually, utilities outperformed in the cycles that continued beyond year 3 more often than they did in the ones that topped, and vice versa. Healthcare outperformed more often in the cycles that topped in year 3 versus the ones that continued beyond. So, thinking in terms of utilities, it's almost counterintuitive that we would see this defensive leadership. We'd think it would be a warning, but history would actually note that this outperformance, and we'd note that healthcare is underperforming at the same time. History would suggest that would actually be more consistent with a year 3 bull market that continued even beyond the third year. So just an interesting historical anecdote that we shared with clients this month.
I love that. And what's interesting is in 2024, utilities at times, again, have been quite strong. Arguably, utilities have ended up being, a growth play in 2024, right? With the sort of the energy needs of AI and cryptocurrency mining and all of those things that require a ton of energy. But this is actually saying that it's not just a 2024 thing. This is actually, utilities have done pretty well. How does that make sense? I mean, what do you have a sense of why that would work? Or is this just one of those, phenomena that you have to trust the fact that consistency matters and utilities tend to do well here?
I mean, there could be something to be said that just as the cycle matures, that defensives, participate a little bit more, even if you're not at that end of a cycle, that there are periods through history where, they don't have to just fall less in a down market to outperform. And if you look a little bit more closely, what was interesting, I think maybe this speaks to not necessarily the history, but what's happening now, is that they just had an abysmal low volatility in general 2023. And so a lot of this was catch up. Like the outperformance isn't coming by the fact that high beta areas are breaking down. There's just been this significant catch up with a lot of those stocks now just breaking above levels from a couple of years ago. So it's happening at least in a more positive way than if they were just happen to outperform with the more cyclical areas breaking down.
You'd mentioned earlier just the market keeps on giving and just sort of follow the trend to the upside. Don't fight the tape is the one way that you described it in your recent report here. Talk about looking at the cap weighted S&P, the equal weighted S&P. What does that tell you about the conditions here going into November?
Don't fight the tape. Marty Zweig, never short a dull market. Mark Holbert, I believe there. And I think this chart here just speaks to what's going on. There's not much more to be said except for the markets are working and they're behaving in a way, how we're framing it, consistent with an uptrend that should continue. Here we're looking at both the cap weighted and the equal weighted S&P. So we're even de-emphasizing those large Mag 7 stocks in the bottom panel, coming off new highs. Any way you slice it and dice it, as much as it's worked, the markets have worked and risen and gone from the lower left to the upper right. That's what happens in a bull market, that there's really no glaring divergences. You're not getting weakness in equal weighted S&P or in market breadth overall that would suggest that market top is performing. So kind of as we think about confirmation, a characteristic of a trend that should continue, divergence would suggest you're more at a reversal point. We see more action that would suggest confirmation and an uptrend that should continue.
One of the OG market letter writers, this guy, what was his name? Oh boy, I'm blanking on it. The guy used to Paul Montgomery. That was it. He wrote a paper, Universal Economics, and his quote was, "The most bullish thing the market can do is go up." And I've been reminded of that many times here in 2024. We're now looking at mid caps and small caps. Talk to us about the trend in sort of cap tiers, so far in 2024 and now going forward. Like, where do you see opportunities now?
Yeah. So, for starters, this speaks to the same point. So now we're just kind of looking at all these key benchmarks and they're all moving and making new cycle highs. Now, I think in terms of absolute price and relative performance and where I want to be positioned in terms of, being a momentum investor, where's the greatest relative strength? And I think what's notable about this chart, for starters, Russell mid-caps showing very similar strength as the S&P 500. They were able to break above their 21 peak more recently. In fact, even I would argue that those breakouts typically are followed by an acceleration in price.
Yeah.
Small caps are working. They're above a rising 200-day average. They've been kind of grinding higher. They kind of started to just come out of their base, even coming into 2024, but they haven't made these new all-time highs just yet. Now, that could just be a matter of time. That could be the rotation potential. But still, as I think about, relative risk and relative weakness, I would still say I want to be in relative strength. I want to be in what's working. To us, large and mid caps would still rate higher for us than small caps. I'd love to see small caps to work. If that's going to break higher, most likely my large and mid cap stocks are going to be much higher along with it there. But then I think the other way, if I'm wrong on the market call, that there's relative risk and relative weakness, and that there'd be some added downside in that small cap index is what the market, how I read the tape.
Sure. Talk to us a little bit about interest rates, because obviously there was a trend in rates kind of coming down, right? The 10-year yield came down for like 5%, getting much lower, down below 4%. Now in the last month, in October, we've seen 10-year yields go back up a little bit more. Talk to us about the interest rate environment now. What does that mean for, potential leadership themes going forward?
Yeah. Well, and this is what changed during the summer. You had this breakdown in interest rates and coinciding breakdown in the high beta versus low volatility ratio, which measures offensive stocks versus defensive stocks. And you had this risk-off breakdown in interest rates. Rates, be careful what you wish for. Rates started moving lower, but guess what? That could be the market signaling more imminent recessionary risk. Now, they found a floor, which I think is a good thing. Generally speaking, I suppose low and rising is good. High and falling is bad in terms of rates and their implications for equities. But really, I want intermarket stability. I don't want them too high. I don't want them too low. I think equity markets do best with range-bound interest rates, range-bound currencies, range-bound commodity prices. I think that's what we have. But this kind of more moderation could be consistent with that, later equity cycle, and that the fact that we are pushing into this third year. And what does that look like going ahead? Are we going to get another turn lower? And I'm going to be watching that equity leadership ratio as well. So rates have started to move higher. Beta has started to outperform again. Can they significantly take on a leadership role where they start to move out to new relative highs? And that's going to give us some clues as far as where we are in this cycle. if it can, it would suggest that we could continue even beyond 2025. But if you get another rollover in that equity ratio, we have to be more mindful of a potential market top at some point in that 2025 period.
Ari, you and I think, made careers out of talking to people about momentum investing and following trends and just the benefits of continuously focusing on opportunities. Talk to us a little bit about the momentum factor, the performance of momentum names in 2024, what that means about where we should be placing our bets now.
Sure. And again, this is our process. This is our methodology. We have our top-down views. End of the day, we are trying to build portfolios of diversified portfolios of high momentum stocks. We define momentum generally with a 12-month look-back period. And what academic research has shown is stocks that have outperformed over a prior 12-month period are often stocks that continue to outperform on a look-ahead period. It's a market anomaly that has worked looking at a century of market data. No style of investing always works. Growth investing, value investing, momentum investing, but through various market cycles, it has proven to be an alpha generating strategy. And so we're very in tune with it. We know when it's working, we know when it's not working, and when it should work and shouldn't work. Typically later in these bull market cycles, we found it does typically outperform. That this is not the point to play rotation, I guess is one way. Stick with what's working. The cycle's leadership has been established. So this is, as we've kind of thought about this period where, could we get some volatility going into the election? There's some divergences beginning to emerge in the daily S&P's 14-day RSI. Well, rather than trying to be cute and trying to market time and sell and buy back, we're saying this, stick with strategy. If we get a setback, I know what I want to buy. Get your list of high momentum stocks. If we're worried about some sort of rollover in the stock market, I'll tell you exactly where you don't want to be. You don't want to be in those low momentum stocks there. And the factor has worked. We are showing on a market neutral basis, on a relative basis, the factor has moved out to a new cycle high as well.
It's interesting as we've talked, through some of these charts, Ari. I mean, and again, 2024 feels in a lot of ways like a 2021, kind of this low volatility, steady grind higher. It keeps going. But at the end of 2021, of course, we had the beginning of 2022 where all of that sort of changed, right? And obviously we went from a period of accumulation to a period of distribution. At this point in the cycle, as we're reaching sort of that median amount of a bull market phase, what are some of the warning signs you would be looking for now, kind of going into the new year, that would tell you that maybe this bull market is starting to exhaust? Is it a rotation in leadership? Is it a change in some of the largest names that have done quite well? Is it an improvement in defensive areas, breadth? Like what would be sort of your go-to signs that we need to start being more defensive or more concerned?
Three things I'm looking at: internal breadth, market leadership, interest rates. First for market breadth, I love to look at the percentage of stocks above their 200-day moving average on the NYSE. What we found is that it's not just about divergence, but it's the level of the divergence. When you have new S&P highs and it's undermined by a reading in that indicator below 60%, it's captured most of the major market lows over the last 30 years. Two, going to be looking at market leadership. Are we seeing a more of a turn towards defensive stocks, looking at that high beta versus low volatility ratio? Going to be especially concerning if it's being driven by a breakdown in some of these cyclicals, and we're starting to see some cracks and culprits begin to emerge. And finally, interest rates. I'm of the view perhaps that lower rates isn't as good of a thing as many others believe, that very often that is an indication of more imminent recessionary risk, that if we were to get a significant breakdown in interest rates, that could be another one of those warnings that a market top is not far behind. So as it stands, really not seeing, there's some yellow lights there, in terms of the leadership, but I think it is being balanced by positives elsewhere. Market breadth, most notably, I think is broad enough that would argue against the market top scenario.
Oh, well said. I love those. Looking at breadth, looking at leadership, looking at interest rates. Three really great points to be made there, Ari. Let's finish off our discussion. Just talk about some areas of opportunity. You've highlighted a couple here in a recent note. The first one is capital markets in the sector spiders, the S&P spiders. There's a bunch of these ETFs, the KBE for banks, KRE for regional banks, KIE for insurance, and you're highlighting KCE capital markets. Talk to us about the technical implications, the justification for optimism on a chart like this.
Love this industry. We went back. We do weekly reports. Since August of 2022, we've written on capital markets favorably 18 times in 18 of those weekly reports, which just goes letting our winners run on here. And we do think there's additional upside. What we found and what was so notable to us is here we're looking at a very long-term monthly chart of it going back to even 2005. We're looking at that capital market spider KCE that you noted because it's equally weighted as well. So it's not just being driven by Goldman Sachs and Morgan Stanley. This is capturing a broader swath of the industry, some mid and small cap stocks as well. And what we found is that for in a prior decade, this tracked banks pretty well. And a lot of that downturn you saw from 05 into 2015, it was very correlated to interest rates. And then something changed in that 2015-2020 period. Interest rates kept moving lower. They made significant new lows during the COVID period. Banks made new relative lows. Capital markets did not make a new relative low. They started to carve out this base, and you see it even in that it's a 4-year average, really capturing that long-term trend. And it started stair-stepping higher. It became a leadership area even ahead of the bull market turn in 2022. It was showing relative strength ahead of the upturn in October 2022. And then as the market turned, this group really started to break out. It started to break out from levels from even before the great financial crisis. And it's turning on a relative basis. It turned versus the equal weighted S&P. Here we're showing now it's turning versus the cap weighted S&P. And we see a large structural shift going on. So as we think about high momentum and wanting to be staying true to our methodology, this is high momentum. It's one of the top ranking industries. It's broadly strong. I could probably rattle off 10, 15, 20 names in this industry that are just moving from the lower left to the upper right. And those are the charts telling a story. That's what we love to see when it's not just being driven by one or two stocks.
Yeah. Yeah, to your point, KC equal weighted, and so there are a lot of individual names in that ETF key holdings that just continue to go higher. There's some beautiful charts, I think, underneath the hood there. The second one, aerospace defense. Obviously, this is a group that's done pretty well given some of the geopolitical uncertainty and escalations in the Middle East, but still an interesting idea here.
Another one that we're seeing some improvement in the relative trend. That's the bottom profile, absolute price on the top. Versus the market on the bottom. And it had been starting to try to come around in 2024, had a little summer reset. Now it's trying to turn up again. And this kind of reversal in the 2-year trend, probably since that 2022 level, kind of also all developing within this 5-year reset, even dating back to 2019. This was one of the industry's, one of the poorest performing 5-year periods on record. If you were to look at like a 30-year chart, this was one of those just long-term structural leaders that's now going through a painful 5-year period. And we're thinking that maybe this could be a turn in the industry because in that report where we highlighted it, we showed there was just enough, the same type of relative strength in mid caps. It was working in small caps. And so for all those reasons, as it starts to pick its head up on a relative basis, we wanted to highlight it.
I love it. And then utilities, obviously, just starting to break out yet again. And the relative strength now starting to improve again. I think that's been one of the challenges for Utes is sort of a chronic underperformance, but now starting to rotate on a relative basis, right?
It is. So we moved it up to market weight. Our top 3 sectors, let me start with this: financials, industrials, technology. I'm not ready to put this in the top 3. And you can't. Not everything can post above average returns. Not everything can be an overweight sector. But I think there's enough here as I think about this directional improvement, as I think about that year 3 market study that we put together, just as being a safe haven. It's the best defensive sector. If you want to own a defensive sector, I would say this is it. And it's working in absolute price turns as well. It's just starting to break above its 22 high. So maybe you want to be selective, and I love those power generation companies. I mean, those are the high momentum stocks in that group, and that's what's really driving it. And I think at the very least, some bullish exposure is warranted.
Ari, this was awesome. A lot of fun as always. I appreciate you so much coming on and talking through some of the charts and takeaways that you have right now. Also, I know you recently joined the board of the CMT Association. They are better off for that. So I appreciate you donating your time and expertise to a great organization. But thanks for joining us here today.
I appreciate it so much, Dave. Looking forward to next time already. Have a great fall, and I'll talk to you soon.
So in the introduction, I talked about Ari Wald as sort of a market historian. Hopefully you saw what I meant at the beginning there, where he showed some, sort of deep statistical analysis, just looking at how long bull markets tend to last. And while, as he said, there's no guarantee that we're going to have a very similar experience today, it is helpful and informative, I think, to look at where we're at now relative to where we've been and think about what that means relative to previous market cycles, what we call historical analogs. Thought his thoughts about what that third year of the bull cycle might mean, some of the things he would be looking for. And I thought his comments in particular about, danger signs to be looking for when the market is so good. As a reminder, we talked about market breadth. We talked about changes in leadership. We talked about interest rates. I would wholeheartedly agree with that assessment of those as three key areas of the market to focus on. Hope you enjoyed that conversation with Ari, particularly three areas of the market where he was seeing some opportunity through the remainder of 2024 and into the beginning of next year. Would love to know who else you would like me to talk to as part of this Market Misbehavior podcast series. Just drop a comment below the video if you're watching this on our YouTube channel and let me know. Always looking for good ideas, or shoot me an email. info@marketmisbehavior.com is another good way to get your ideas over to us. By the way, if this sort of discussion about trend following, pro-momentum investing, thinking about market history and the lessons you can learn by a consistent and systematic analysis of the charts, if you think that might be helpful for you, our free behavioral investing course may be a really good place for you to upgrade what you know now and set yourself up for success in the months and years to come. Go to marketmisbehavior.com/free course or just scan the QR code you see on your screen, and I look forward to having you there and helping you along in your investing journey. For Market Misbehavior, I'm Dave Keller, and remember, it's always a good time to own good charts.